rate short-term debt for a period of time. We thought about it, and it just didn't make a lot of sense. So we're in a, I don't think anybody's in a great position these days, but we're in a pretty attractive, relatively attractive position because, again, we don't have a lot of debt coming until 2013, 14, 15, and even out till 16. But what we have been doing with some of our near-term maturities where we think there might be a slight degree of refinancing risk is we've been going out to the banks. And the good thing is most of our lenders on our multifamily assets are balance sheet lenders. So we're going out to them and we're saying, hey, look, let's work something out. We'll do a partial pay down on the loan and give us 2, 3, 4, 5 more years of term. Basically, our theory on the multi side is that these are great assets owned for a very long term, and if you hold on to them long enough, we'll all do extremely well. And they're great cash flow producing assets, and if you have the term, you can survive the down cycles. And that's basically the position we're taking. And anytime we see any term risk at all, we're going directly to the lenders and saying, let's try to get some term out of this loan. And we've been very successful in doing that.
Mason, let's go to a different question. What are you seeing right now? What's the pipeline look like for the 010 since 09's gone?
What we see, and we spend a lot of time canvassing, among other things, the lenders, as I'm sure most of the other buyers do here. But what we see, by and large, is kind of a tale of two cities. There is a lot of product in the market that I would term junk, stuff that we wouldn't be interested in, stuff that's vacant, stuff that doesn't cash flow, stuff that is functionally obsolete. And then there are a few really nice assets that come to market, whether they be as a straight equity sale or through a loan that is a loan-to-own situation or an REO situation. And those are extremely tightly bid. We'll see 30 bids, 40 bids. There was a time 6 to 12 months ago, I think, where the banks were doing private deals, one-off deals. Now, with the market as frothy for decent product as it is right now, at least in our opinion, they're typically using brokers. They're widely marketed. There's a ton of money chasing those deals right now. So for us, what you see in the market is not a whole lot that we would want to buy. And where there are things that we would buy, we find it difficult to be competitive. Again, we're an opportunistic fund, so we're essentially looking for the one-off deals, and we find them here and there. We've bought 3 things over the past 6 months, but it's hard to find them.
Tim?
Our company have acquisition team around the country. What we have seen is we believe August was the market bottom. And it's a game changer. What happened is that if you remember at that time, a few large REIT companies were able to raise secure and unsecured debt in large amount. In particular, Simon Property was 5.5% coupon, which is phenomenal. Since then, based on our observation and market data, we believe cap rate compressed by 50 basis points. And so value probably increased by anywhere between 5 to 10% since then. So the market is moving rapidly. Just don't look at the Moody's transaction data. That's a little bit lagging. So the market already moved. We believe already reached the bottom in the near term. In terms of product, I agree with Mason. We haven't seen a lot of good Class A product in the market. So definitely it's very competitive. Actually, our company lost a few deals because we were outbid by other bidder. Because if you use cap rate or NOI or IRR to underwrite your deal, it's not working very well these days. Most people are using the price per pound, the dollar per unit, to justify the new deal. It's very competitive out there.
And just to add to that, we've at CBRE we've seen 2 types of products come on the market. More recently, sort of those A-class, more primary market multifamily properties. They're rare. Our New York office has sold and financed 2 or 3 of them recently in the New York area. So those are starting to come to market, and then continuing with some distressed assets, either as REOs or out of foreclosure, and those are getting done as well, a little bit more frequently than they were in the last 12 to 18 months. And just with regard to the first question, in terms of multifamily and the massive amount of debt that is coming due over the next 10 years. It's a little different than the commercial side. There's actually pockets of money for multifamily that should give multifamily owners with existing debt coming due some comfort. As long as Fannie and Freddie are in the market, there will be an appetite to refinance the existing debt on multifamily properties that come due, unlike retail or office properties, where the CMBS market is falling out. And there's always, fund money and banks that are attracted to multifamily properties significantly more than other asset classes. We've at CBRE to date have done close to $4 billion in multifamily financing this year, whether it's through the agencies or bank business. So, if it's an average of $40 billion, that's basically a tenth of the average that's coming due. And there's, obviously tons of direct business and other broker business. So I think multifamily relative to the other commercial real estate asset classes will be able to be refinanced out, the existing debt, at least relatively more successfully than the other asset classes.
I'll take a contrarian approach, and I'll get to you. And I've been a deal guy for a long time. Okay, so I'm not. We all know there's tons of product behind the dam, right? Simple chart right here. The 12 cities, and we're all apartment guys. The 12 cities from basically D.C. down to Austin. You have 255,000 units that were built in the last 5 years. This is per MPF, right? If you look at 80% of those were merchant-built deals, let's say you got 200,000 units that need to clear, okay? The other question is that we all know, as Mason said, a lot of the stuff is crap, so you've got a barbell world. You've got a Class A and crap hitting the market, right? TREP came out yesterday, and they're having 8% delinquent through apartments through November, okay? How do we sit there and justify the craziness that we're all seeing on the Class A deals, on the 3 or 4 deals that were that CB, ARA, everyone's pitching, that are getting bid up to crazy numbers that are not justified by IRR,
Well, I think
cash flow? Go ahead.
I think it's really what Tim said. We are I guess a cap rate and IRR buyer, so we can't be competitive today. We price our deals to a 15. There's 2 types of deals on the market. There's a core deal that today is going for a price per unit. I think core deals in February, you would have 2 bids and it would be a 7 to 8 cap. Today, a core deal has 35 bids and cap rate doesn't even matter. Chicago, we actually just had a deal go to a condo converter for the first time in years. And I think an interesting story, and it'll show you how frothy it is, we're very entrepreneurial for being a pension fund, I guess, advisor. And we showed up 2-3 weeks ago at the courthouse steps in Washington, D.C. to try and buy a foreclosed asset. And we've done this in the past. In fact, Mike was our partner years ago on one of these transactions. And typically we show up and we bid, and it's us and the lender, and either we win or we don't. This time we show up and there's 7 bidders. We don't even get to bid. Our number gets blown out of the water. And we spend, a day or 2 of just shaking our head going, what just happened? But it is frothy out there for the core. And if you don't see core, we call it, we're seeing a D property now. It's not even the C stuff anymore. So I think you make sense of it because you look at the per unit and you say, God, these properties traded at $100 a unit 2 years ago, and today I'm buying them at $60 or $70 a unit. I know that I can't financially show it to my partners, but my gut tells me at that per unit I'm going to make money. And I think the people buying these for the most part, until most recently when you started seeing a few, I guess, more core buyers, were the private people that weren't around for the last 5 years. We're starting to see a lot of people we never even heard of buying deals because they just know that the per unit makes sense to them, and they don't have to go to their partner and show, I'm buying it at this cap rate, this cash on cash, and I'm going to hit this IRR with these growth rates. So it's really a guy who's just looking out there and saying, I know the price per pound makes sense to me, and they're making a bet like that. And they're also, to some extent, they are doing floating rate debt, and they're getting a pretty good cash on cash today. And I think, they're making a bet that in the long term that, the price per unit's going to pay off.
Kevin, what do you tell your partners, Kevin, Mason, Tim? What do you tell your pension fund in your quarterly meetings? You haven't done a deal or haven't done many deals in 08 or 09. What do you tell them right now about apartments?